We're snorting cap rates and shooting up cash flow here at Deal Junkie. All right, welcome back to the Deal Junkie Show. I'm Gabe Johansson. I'm here with Trevor Howard, Mike Nuss, and Dane McKinney. Today, we are going to talk about economics.
Yeah, we got
macro Mike here.
Oh, yeah.
Most important time in the ever history of our planet.
Our speaker.
Important history of our planet, economics. This sounds deep. Okay, so we're going to spend a little bit of time with our local expert here, Mike Nuss, talking about economics. I'm going to pass the mic to Dane to lead the charge on this. I'm not smart enough to ask even the right question, so we're going to let Dane lead the charge here.
I'm just quoting an article.
What's the homework I didn't read?
The homework you didn't read is from CoStar News.
Oh,
thank you, Gabe.
CoStar.
They're good. They're good data.
They are good.
I like CoStar.
They are good.
Second largest data holder in the globe outside of the government.
Wow.
Really?
No wonder they charge me so much money.
Right?
Just like the government.
This episode's sponsored
Maybe we should
by
hold more
SMI.
data. Let's leave right now and go get some more data.
They've got more planes than Boeing. Not really.
Oh, I was trying to process what that even meant.
That's the sales pitch. When the salesman comes in, and we've got these planes and they fly over and they take aerial photos and you get real-time data. Yeah. Oh, yeah. That's the sales pitch.
Have you heard about
They have
BlackRock
a
doing
web
that?
page showing their new plane.
Really?
That's the sales pitch.
Oh.
Yeah. Okay. We can move on. Let's get to economics.
Okay, let's get to economics. Great news. The Fed declares interest rates have reached their peak. Obviously, you knew this was coming months in advance. But for the rest of us,
Mere more.
we weren't sure. Including, seems like the secondary market, because rates just started to...
Yeah. My favorite comment lately is the markets should just watch my Facebook page and they would know. They would know.
So if you're listening and you don't follow Mike Nuss's Facebook page, you definitely want to follow Mike's Facebook
Well,
page.
Mike, real quick on that. We're friends on Facebook, but you won't follow me back on Instagram.
He's too old for Instagram.
I even know he's on there.
That's for like pictures of your hike and stuff.
Yeah.
Look
That's
at
what
him.
He's posting.
He's reading economics books. He's not on a hike.
I even unfollowed him and refollowed him, so you
Did
get
you
the
really?
notification. He still didn't follow me back, but you followed all our other friends.
I haven't. No. Have I?
That's so funny.
This is awkward.
I don't even know how to follow on Instagram.
It's all right, though. Anyway, economics.
Yeah, economics. Yeah, Fed.
So we
reached
can
their
start
peak.
setting the stage quite
Yeah,
a bit.
please
So I
do.
think a lot. So obviously the Fed changed. They pivoted in March of 2022. November of 21, they said they're going to do this. And like in the summer of 2022, a lot of things changed. And kind of the same thing happened in 2023. And I think what it got really clear in 2023 was in June or July, and the 10-year yield was approaching 5%. It's like 4.8, 4.7%. And Powell came out and said, I think the bond market's doing our job for us. And that was the first time I really saw like, okay, the Fed's now starting to kind of capitulate with considering a change. And I think what everyone thinks of the word pivot, and I had one post was like, pivot was the most overused word of 2023. And the reason being is the Fed doesn't pivot. Like the Fed doesn't say we're raising rates today, we're going to lower them tomorrow. And if you look back since, I think it's since the dot-com crash, you can literally see, and it's even before that, it's in the 90s. It was that recession in the early 90s. But you can see they change rates, they keep them flat. They change rates, they keep them flat. And it's just, that's their pattern. And so we're obsessed. The markets are obsessed with this pivot. And the entire time the Fed's been saying, this is what we want. This is what we want. We're getting there, but we're not there. And they also changed the way they look at data in August of 2020. And so for me, it's been really clear. The Fed wants data. It's going in the direction they want it to. It's just not there. And so when the Fed said that when Powell came out last summer and said the bond market's doing our job for us, meaning borrowing rates for the government are so high, the yield curve is so high, it's already slowing down borrowing, slowing down economic activity. So regardless of what they do with rates, the markets themselves have put the brakes on, right? And so if you think of how it worked, the Feds early on in March 2022, they went really fast, 0.75, 0.75, 0.75, and the bond market got out ahead of it. The Fed caught up. Summer of 2022, there was some dovish speak from the Fed. Bond market started going crazy. And that's where the Fed from July, August, September, October, and November went on this assault of the markets in 2022. And it was yields had come back down. Interest rates got back to 5%, like on the first day of August. And then it was hawkish talk, hawkish talk, hawkish talk. So every opportunity a Fed president had to get on the news, it was, we're not cutting rates, we're increasing rates, we're increasing rates. And it was a very hawkish tone. And then they went to Jackson Hole, came out of that very hawkish. And so everything was really, really hawkish. And even in December of 2022, the market started talking about a decline, a cut in rates in early 2023. And at that time, it made absolutely no sense based on what they were saying, what they said they want to be. And then we had a really strong job report in January 2023, 500,000. And then like the market just stopped. And so we had this rally at the beginning of 2023 and then things slowed down. We kind of went back towards this recessionary thing and we've had this stuff going back and forth. But in the summer of 23, when Powell said the bond market's doing the job for us, you know, we were at 4.9% on the 10-year yield. And I went to Facebook and said, the Fed won't allow yields to get over 5%. They got to like 5.1 and then quickly came down. They never really went above 5%. And why did I make that call? Because if you look at the way that Jerome Powell's communicating, the way that, and then you look at the way the actual notes from their minutes, you go back to August 2020. A lot of people don't realize August 2020 was a big, huge deal. The Jackson Hole Summit, where they changed the way they look at data. So up until August 2020, they tried to guide the markets. They said, hey, we're going this route. We don't like it going this direction any further. We're going to change. And the markets still think that that's how they act. Like the Fed is now guiding our market. But in August 2020, they said, hey, all of 2019, we did this year-long research on how we've implemented policy over the past 100 years. And what we found is it's better to actually look at data and then make reactive decisions than it is to guide data and try and push the economy the way it's going. And I guess because we were in the middle of COVID, no one just pays attention to that. But if you go back to that date and then you look at what they've done since, it's very clear what they're going to do.
When you're saying they're guiding data, like what do you mean?
Yeah, so think of their target 2%, right? So right now, all the markets for 6+ months now, time to cut, time to cut, time to cut. And why are they doing that? Because they're getting close to their target. But the past Fed before August of 2020, the past Fed would be, yeah, we could probably really, we don't need we can just, they would guide it. Hey, we're getting there. Now we can release the brakes. We can change policy. So pre-August 2020, that would be their take. Now it's like, hey, we're not there. And the other statement they made at that time was, we'll also let the economy run hot. So in August 2020, we had 20 years of no inflation or very, very little inflation. And so when they announced this change, the example they used was, our target's 2% interest or inflation, 2% inflation, but we've had this long period of time with less than 2%. So we'll allow a period of time greater than 2%. So now relay that comment from August 2020 to where we're at now.
They were going to let it average out.
Yes.
So rather than just looking at it each meeting to meeting, we're going to let it run hot for a little while and just say, well, we were running cool for a bit. Now we can run hot for a bit and it all averages out.
Right.
You say we had less than 2% for 20 years?
Yeah, for a long period of time. Yeah, and I don't want to get into this. That's one of the...
And they changed their metrics and measurements on that during that 20 years as well.
How you measure inflation, and is it consumer prices? Is it consumer expenditures? Is it so I don't want to kind of get into that number, but they have what they like, the gauge that they like, the consumer, the CPE. PCE. But here's the scenario. If you overlay what they said in August 2020, my opinion is they want to get inflation down under 2% for a period of time.
To get their average.
Exactly. And we're not there yet.
Which they told us 4 years ago They wanted to do.
And the Fed has two mandates. It's price controls. We don't want inflation getting out of control. And then it's maximum employment. So as a market investor, why would I think the Fed is going to cut rates when we have a historically low unemployment rate and we don't have inflation under 2%? it's very clear to me they're not going to cut. And so what happened was in November of this year, just like November of last year, not this year, but 23, just like in November 2022, the bond market started improving. Inflation reports started getting better. Oh my gosh, this is working. Job reports started kind of slowing down. Oh my gosh, this is what we need. We're going to change. They're going to cut rates. They're going to cut rates. No,
Nope.
because we're not. Yes, it's getting where they want, but we're not there yet. So huge bond rally early December, huge market rally early December. I think it was December 3rd or December 7th. I posted on Facebook. Anyone betting that they're going to cut rates before June is stupid. And what? So
I made a bet.
what's that? It's a good fucking bet.
I made a bet with somebody else that it wasn't going to happen before June. I did not see that post though.
Really?
That just made me really happy. That's why
It should make you happy.
Yeah.
So, and then what happened? And then, they had their meeting. Powell came out, and the day before he came out, I was like, hey, really good day for Powell. He gets to try and push back the talk on rate cuts while then saying, hey, inflation's going the direction we want. So like, how do you say we're about to put the brakes on, but we're not ready to cut? So that's what I expected him to do. And he came out, and the markets completely misread what he had said. So he came out, had the meeting, he came out, and the market's takeaway was, they're done raising, now they're cutting. And when you actually the following week read their meeting minutes,
Didn't say that anywhere.
they didn't say that anywhere. And headlines go with this. They just take it and like, now they're changing. Well, no, you read the actual. So you got to listen to their comments. You got to actually read their documents, and you can kind of put these things together. So then right at the end of the new year, now the stock market starts kind of losing, mortgage rates start going up, bond yields start going up. Why? Because they completely misread the Fed in December. So now they got to backtrack in early January. And then now we have another Fed meeting kind of coming up. And so Powell was on 60 Minutes, and he's pushed back. And now he has to push back even harder against a March cut, because the markets just feel like this thing's going to happen. That's not.
Yeah, because if, to your point, in guiding, instead of guiding the markets, they wanted to react. What's interesting now is that it's not their moves that actually are changing the market; it's their words.
Yes.
And so I've said all along, we don't really need them to cut rates. We just need to tell them they're done raising rates, because in my opinion, what paused all the transaction volume in commercial paused, because everyone says, well, I'm going to go into a deal. I don't even know what my rate's going to be in 3 months, let alone if I can refinance this in a year, 2 years, or whatever. And if rates have the risk of running as hot as 10, 15, 20%, we're going back to the 70s again, then there's too much risk. I'm just going to sit on the sidelines and wait. So we just need to know that we're making progress.
Yes.
And they need to say, okay, we're done for now. But what's interesting, at some point, they're already talking about how they'll do some rate cuts this year. Mm-hmm. And the market has, I think, 1.5 points baked in, and the Fed is saying that the dot plot's like 0.75 or whatever. So the market's baking in twice as much as what the Fed says that they're going to do. So to your answer, the market is really, really wants them to cut rates. Mm-hmm. But what'll happen as soon as they get too dovish and they start talking about cutting rates, before they even cut them, all the markets are going to react, and they're going to actually start unwinding some of the work that the Fed has done. And I think that's why their job is so hard right now. And they want to say like, yeah, of course we want to cut rates, and we will, but they can't really just come out and say it, or it'll screw everything up.
Yeah, the analogy I've been using for this is like the markets are like the little kid who wants to go outside, and the Fed is like the parents that are inside like, hey, it's been raining, and the kid's like, oh, the clouds are gone and the sun's coming out, and the parents are like, look at those dark clouds back there, right? And so they just want to go out and play, and they're like, we can't let you play yet.
It's a good analogy.
Yeah.
Well, in that article, did they not say they're going to cut by 150 points by the end of 2025 from
the market has baked in
co-stars? Yes.
Yeah, I think that's Mike's whole point.
Yes, exactly.
Yeah, which is why I wanted.
I read that as Jerome Powell said.
No.
Well, that's most people do.
Yeah, I don't know how to read, I guess.
So there was two really huge things that came out last week, and that was they did say we're done raising. So that's
important. That's what we've been waiting for, I think.
Super important. Yes. Mm-hmm. That's the pivot. We've now pivoted.
Now we can get back to doing deals.
We have now pivoted. We now know that we are in the holding pattern. What have they said the entire time? We want to raise them, and we want to hold them. We want higher rates for longer. Now we know that they have hit higher rates. They're no longer going beyond that. And you look back, well, when was their last increase? Was it June or July? Something like that.
4 or 5 months ago.
Yeah. So we are already 4 or 5 months into the for longer,
Mhm.
higher for longer. And then the other thing that they came out and said is we're no longer concerned about wanting to see a reduction in or an increase in unemployment. They're no longer concerned about the job market. So that was the thing of all of 2023 was inflation was going the direction they wanted, but the job market wasn't. The economy was so resilient, the jobs not getting enough jobless claims, and we're having too many new jobs reports. So 2023 was focused on jobs, and because all the jobs reports for the most part were really good, there's no reason to, not even to pause, there's actually reason to increase. And so that goes back to like May and June and July, those last there's a lot of, are they going to pause? Are they going to increase? There really was reasons because of the job market to increase. And so what they said last week was, we're no longer looking at the job market. We feel like policy is sufficiently tight. Can't remember the word they use, that they like to use.
Restrictive. Yeah.
So they like to use it's sufficiently restrictive to get us to our target goal on inflation, meaning we're no longer going to look at the jobs reports. So this is really good because now jobs reports can be really, really strong, and we know the Fed won't increase. So now the Fed's really just looking at inflation. But remember, our mortgage rates don't act off the Fed, they act off the bond market. The bond market still doesn't like the strong jobs reports. And so we have this scenario where the bond market's kind of 3.8 to 4.1 just is kind of laid in there. And
tell us what drives the bond market. If it's not, so the Fed has a couple of levers they can pull. They can do their interest rates up and down, which is really the overnight lending rate between banks. I don't even quite understand that. The other one is quantitative tightening or easing. So they can basically pull their chips off the table in a sense, in the fact that they're no longer a buyer competing in that secondary market for mortgage-backed securities or whatever they're buying. So they manipulate the market. And I guess I would be interested to know your opinion as to which affects actual borrowing rates more, the quantitative tightening, easing, or the overnight borrowing rate, and how that actually affects interest rates. And then also what is the bond market looking at, and what drives that if it's not the moves that the Fed is
my
making?
favorite analogy, we've all built fucking Kia furniture, right?
Yeah. IKEA. I was just there. Oh my God, I hate
the
it.
analogy I use is interest rates are like that shitty little tool that they put in the package. And then their bond buying program, quantitative, their balance sheet, that's like you go get your power drill.
Okay.
And so that's the
real tool.
The real tool.
And nobody really talks about it all that much.
Yeah, because people don't get it. They don't understand. And we hear like bond money is the smart money. You know, like stock market's the risky money. That's the equities.
Mm-hmm.
That's where you get aggressive. You take on risks. Bond markets, it's smart money. That's where macro money parks itself, right? It's the biggest amount of money moves in and out. It moves in and out slowly. And the majority of up until 2008, 95% of the bond activity was institutions and governments buying bonds. And then 2008, now the Fed got involved, right? And so the Fed is not a lender. They don't make bond buying decisions based on inflation adjusted return. They make bond buying decisions based on how much money we want in the economy or out of the economy. So they don't treat bonds as a normal investor would. And so the biggest change that we've seen in the bond market since March 2022 is the Fed pared back. You know, they went from 120 billion in buying in bonds to 90, and then now they're down to, no, they went to 75, 85. Now they're at 40, whatever it is. So they paired by 45, they paired. So they're still buying bonds. They're still actually pumping money into the economy. They're just letting them mature faster than they're actually.
Let's go down a rabbit hole real quick.
Yeah.
The way I'm imagining this is nobody else can print money but the Fed. So when they're buying something, they're not buying it, like you said, based on investment metrics. They're not saying I need this particular return on my capital.
Right.
It feels as if they're just printing money and then giving it to the government in the form of a bond and in a form of a loan with it's just an IOU. It's just like they're creating money out of thin air and they're loaning it to the government.
Yeah.
Is that what's happening?
Yeah. And so you think of it this way, they actually kind of have two mandates because they have to be the bank for the government. So there's the government activity dictates some of what they do. And then they have to monitor the amount of money in the economy. So they have to buy America's debt kind of no matter what. So that's how America creates money is, hey, we need to spend. We're going to create these promissory notes. We're going to go take them to the market and sell them. And so when the Fed's buying, they're a big buyer. our cost of debt goes down because there's more demand. And so now they're not there. Now they're selling them back to normal investors. And so there's this really complicated market of government creates a promissory note. Investors buy that note. The Fed buys the note back from the investors, and then the Fed does a repurchase market to then go borrow money against the notes that they bought to then go buy more notes from the government. So there's this big, and this is where I argue with ChatGPT that if there isn't a repurchase market out there, meaning the Fed is not leveraging their bonds to get cash to buy more bonds, then when they let their bonds mature, they're pulling money in the economy. But if their bonds are maturing and then they're just paying off a repurchase order, it's a really complicated mess. But to answer your question, when it comes down to interest rates and why does the job market matter now, is the job market only mattered to the Fed on what's our economic policy? What are we doing with rates in order? Are we speeding up the economy or slowing down the economy? The bond market actually looks at it as a lender, meaning I want an inflation adjusted return. And so the Fed may not be concerned about inflation right now because they have it going the right direction. So they're not concerned about the job market because they've got their tool working. But the bond market's different. They're like, well, robust jobs are, because that creates inflation. And so now I'm a lender, but we're really
more people with money.
Yeah.
So there's more people buying the same goods and services. It's going to make the price go up.
Correct.
Regardless of what the Fed is doing.
Yeah. And then the other complicated action of the bond market, when you consider the Fed's buying activity, is before 2008, investors just really invested in the bond market for yield. They go buy a note, they get a return on that note, the note would mature, they'd reinvest that money. Well, now with the Fed, they can just go buy a note and then the Fed starts buying and the value of that note goes up.
Way up.
And now they sell it and they create capital gains. And so you do have this trading activity that's gains related as well as trading activity that's yield related. And so you have to kind of look at the market, whereas, okay, is it moving because of gains related activity? Is it moving because of yield related activity? A lot of that stuff happens at the end of the year. I think a lot of it, the 10-year yield getting up to 5%. The reason it kind of started, there's now trades being made for capital gains because they know the value, hey.
Well, the prices are down. So if the yield is high, the price of that bond is lower.
Yeah.
So now the Fed backs away and now we don't have this artificially driven market.
Yep.
And now you have to let the free market decide what that bond is worth.
Yep.
And the value of that bond drops down, creating the higher yield, creating the higher borrowing rates and the higher mortgage rates when we go buy a property.
Yeah. And so then what that creates then is it kind of creates this channel of where bond yields should be outside of the capital gains conundrum. Does that kind of make sense? And I think one way that this showed up is as inflation reports started getting really good and the jobs reports weren't they were good, but they weren't super strong. Like, well, that's what we want. And you saw bond yields before the end of the year get down to like 3.7%. And before they got down to 3.7%, I'd made a strong jobs report come out and they were at 4%. Strong jobs report came out. I think this was November or December. And the yields didn't change much on the 10-year. And I was like, is the bond market just kind of okay now, given where inflation's at, given where the job market's at, and given it yields at 4%? It seems like we've settled
equilibrium.
Yes, it feels like we have this level of, if we kind of keep here, we shouldn't expect bond yields, the 10-year yield getting more than 4 to 4.1, kind of in that 3.9 to 4.1 range. So that tells you if mortgage spreads are 3%, we're going to be in the 6.9 to 7.1. Rates just kind of went back to 7%. And what we saw at the end of the year was those spreads actually came down to like 2.75. We got up to 3. We stayed around 3. They kind of finally
the risk spread starts to shrink a little.
The risk spread starts to shrink from the secondary market.
Do you think that'll continue to shrink now that the Fed has said, "Hey, we're done raising rates. We feel like things are good.
This is a
now we can." To me, I feel like that could shrink pretty quickly, but everybody's hanging on to the profit.
It could, yeah. So it's jobs related, right? So the Fed doesn't care about jobs anymore. We're pretty good. But the lenders do, right? Because the Fed's like, hey, I'm not too concerned about inflation, but lenders are always concerned about inflation because that's the only way to create an inflation adjusted return. And so when we see those strong prints, The yields went back up
Mm-hmm.
on not just the yields and the spreads went
Because of the hot jobs
Yeah.
print.
So that's why interest rates went from above 7 down to 6.5 back up to 7, is because not only is the 10-year moving, but the yields are moving. And until we actually see a slowdown in jobs, so here's where I was at last year. And here's where I was at kind of the end of last year and the beginning of this year was, hey, our affordability, if you look at affordability, we're teetering on that level of being able to create sales volume. And so rates were low at the beginning of 2023. We had a good sales season from January to March, May-ish, right? We had the banking crisis, kind of kept yields down a little bit, rates better. And then the summer went along and the Fed kind of started talking hawkish again. Rates got back up and it slowed back down. And so it created this buying window this fall. Just like we had a buying window in the fall of 2022, we had a buying window in the fall and early winter of 2023. We're kind of set up again for that. Because if jobs stay strong, and even though the Fed doesn't, and then the Fed's like, hey, inflation hasn't come down, we haven't cut, or they're not even really going to start to cut until June, well, our buying season, our selling season is done, right? Our selling season's done by the time they start cutting rates. So it's quite possible we see 6.5% to 7% rates through our selling season, the spring, and then getting into.
And you're talking a residential
borrowing,
1 to
rates,
40.
Yeah. That's the world I like to reside in because you stack off of that. So we could get in a scenario where we made it through the selling season. The desire to buy is again lower. Interest rates are 6.5% to 7%. Values are stagnant. And it could be a scenario where, leading into this year, I was expecting, kind of rates will come down mid-year. We'll get into that 5.75 by the end of the year, and the market's going to be golden. That's where we want. Values won't go too crazy. Volume will be there. That's what we want to see. But if rates don't get down there, we're not going to see that volume.
Okay, let me ask you another question. This is a very interesting topic. So from a macro level, they're looking at jobs print, they're looking at inflation readings and all these things. But on a Main Street level, if you look at the excess savings that we built up during all the COVID stimulus, we print $6 trillion. Everybody's sitting on more money than they've ever had, right? That's all gone. That savings, a lot of it has disappeared. No?
This is the headline bullshit that gets thrown out there, right? So our savings rate is now historically low. But what is a savings rate?
It's how much money how the average person has sitting in their savings account?
No. That's deposits.
Oh, so it's the current savings rate. So they've already saved all the money, so they don't have to.
No, savings rate is how much of your income are you saving?
Yeah.
So if your
expense versus income.
Yeah. So if your savings rate is down, you're still saving.
Okay. So
savings rate isn't negative.
Okay, so then let's talk about debt, because now the headlines again say that credit card balances are at all-time highs.
Yeah. So I went over this in my yearly forecast. This is fucking excellent. So 90% of America has less than $5,000 of credit limit. Okay. So most of America doesn't have credit, or much of it.
Dane.
Yeah. Top 10% are actually. Yeah. 6,500.
And then 90% of people have 95% of their credit used up. And if you kind of start doing these math and you look at the graphs, the prototypical borrower who doesn't have a lot of credit card
has them tapped out.
Well, no, that's how they live. They tap out their credit cards.
Pay it off.
They pay it down as far as they can.
And they tap it out.
So they live in that 90 to 95% world.
It's their cushion.
Right. And so we're trying to base this economic condition based off the smallest part of our economy. 75% of people have have another 30% of their credit limit. So people still have credit limits left. Now, I do think that our credit limits are overinflated, because there's so much money in the economy that banks haven't started pulling lines of credit yet. Does that make sense?
Mm-hmm.
There's no real need for them. And now we're going to kind of start seeing that where
the banks start pulling away.
Start closing lines of credit. And if you've got...
Like in the 2008 crash, these guys are too young to remember it.
Yeah.
The bank, you've had a credit line, you've had this and that, and everybody's happy. And then one day they just call you and say, sorry, we're shutting it down.
Yeah.
It's over.
So that's where I start. So what are the indicators where you start getting worried? That's an area where they start now shutting down. So if you're 95%, the number of people in your 95% of credit used go to 105% of credit used because now their balance has been used. Now they got fees and now they have no liquidity because that's how they live month to month. Right. And so now these are more like your C-class tenant. These are your renters. They're not your owners. The other thing, if you look at the graphs, you see the deposits, right? So you see COVID, the amount of deposits, they go down significantly, they go up, and then our deposits are going down. But if you go back to 2008, like that,
the trend line,
we just had come back to the trend line. So you can cut, again, statistics are bullshit. It's how you frame them. So if you look at from after COVID to now, it looks terrible. But if you go back 20 years, we're just in line.
It makes a better headline.
Yeah. So, but I'm also not saying this isn't something we should be concerned about because consumers tapping out their debt. And part of the whole holiday season spending was just buy now, pay later programs. It's just debt oriented, right? And so, yes, that is a huge, huge, huge concern at some point.
So let's go next level. The Fed prints $6 trillion. Some say that prior to COVID, if you have $100 in your pocket right now, 40 of those dollars didn't exist prior to COVID. That money goes in, and if you follow M1 and M2 money supply, they've sort of backed off. Like we hit 22 trillion in circulation or whatever. Now we're down to 20 trillion, whatever the number. So they went up 40%, they went back down 10%. So kindergarten question, where does that money go? Like, first off, the people that I read and listen to say that money hasn't even hit yet. It's not even hasn't really hit the ground level. Like that money's been printed. It has to filter through all the government programs and all of whatever that's going to come from. The money that came through COVID related, like unemployment benefits that came, the extra $300 a week and all that hit. But that was actually a very small percentage of the $6 trillion that they printed.
Yep.
So where does the rest of that money filter from? Where does it go? How long does it take? And does that then run the risk, in my mind, that we end up back in an inflationary period because too much money hits the street?
And this is the exact reason why I think the Fed would rather break the economy than not.
Because they know that money hasn't hit yet. They run a couple of risks. If they move too quick, they may have to go back.
And this is the counter discussion to inflation's going the direction we go. It's got rent still hasn't factored into it. We know inflation's coming down. And I think Stanford or one of those colleges, Yale, they've got their own inflation report that shows it at like 1% right now because they factor in all these other scenarios. So if we know there's a delayed print on inflation, yada, 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 we know inflation's coming down. Why are they not lowering rates? Well, to your point, we use the wrong term print. We create credit. You create a credit facility. Those credit facilities have to get spent down. And so what you're saying is there's credit facilities that have been created that still haven't been spent down. One really good example of that is the ERC, the Employee Retention Credit. So that was the most abused benefit of COVID, the Employee Retention Credit. So what is it that they just came out with now? All the new bonus depreciation. So the new tax bill they're creating right now creates, 100% bonus depreciation. That's being paid for with the Employee Retention Credit, right? So that's money that's there that they said, we're cutting this facility off because people are abusing it. Yet we printed that money, AKA we created that.
Now we're going to spend it somewhere else.
Now we're going to spend it somewhere else. So we feel like we still want that money to go in the economy. We just don't want it to go through this facility because it's being abused. So we're going to change the facility and let it enter the economy in a different way.
Sounds like you're not getting your $2 million anymore.
If you haven't got it, you're done. But the other thing we need to understand is the Fed can't spend money. All they can do is buy debt and they can invest, right? So they invest in debt. So what the Fed does is when the Fed prints money, aka creates credit, they just give it to people. So now businesses have better lines of credit to spur business. Asset investors have better debt to buy assets. And so when the Fed prints for stimulus to put money in the economy, assets go up because they can't give that money to Main Street. They give it to investors and businesses. And so business values go up, stock market goes up, more loans, more jobs, the economy goes off, and then asset values go up because that's where they're getting spent. They're getting spent into the economy. They're getting spent into the assets. when you create a stimulus program, so again, now the government versus the Fed. So the Fed, that's just their activity. When the government says, we need to give people $600 every single month, whatever, however much, that's the government saying, we've created this policy, whether you agree with it or not, Fed, you need to now bank this for us. And so they've said, we're going to give this money out. So they go create promissory notes. Right. And so then the Fed, we have to monetize that debt. So now they have that money, and then that money gets deposited in the Fed. And then that money came through the actual treasury. So they create the notes, they sell it to the markets, they create the cash goes to the IRS, and the IRS spends that money overnight, depositing it into our bank accounts. And then as consumers, we spend that money much, much faster than investors invest that money. So that's why a good portion or a portion of this, the COVID stimulus has entered the economy and a portion hasn't.
Do you have an idea of about how much has been?
I have no clue.
Okay.
Yeah.
But there's still that risk. I mean,
yeah.
But to your point, these are credit facilities that they may cut off or redirect. So when they see something like ERC getting channeled into areas that they feel are not beneficial or don't serve the same purpose they created them for, they say, okay, we're done. And now we're going to move that over here. And we think we can run them through these channels instead to help these folks to spur the economy the way that we want.
Yeah. And then now you can use that information as an investor, right? So if the credit facility is ERC, well, that's money going into the economy, into businesses, into the stock market. If that funding gets moved to bonus depreciation, now that money is going to assets, into real estate, right? And so if you know this is happening, you're like, well, I'm a stock investor. I'm pulling my money out of the stock market. I'm buying real estate, right? Because you just get ahead of the curve. Yeah.
Which you should do anyway.
Yes. Trevor, did you get all your questions answered?
I think so. So I was trying to understand the mechanism, though, of like, okay, like let's picture our dollars that we're getting from the bank and how that goes to the Fed. So I really understand it. Explain that to me. Because you're talking about how they trade it, create the promissory note, but how do those actually, like, I go to the bank and get a loan. How does that roll up?
To the Fed.
To the Fed.
Yeah. Okay. So you go put a deposit in at your local bank, and then the bank has their own reserves.
Yeah.
And then the bank that you deposited at has the same relationship with the federal bank. So a portion of your deposits on reserves now have to go to their deposit on a reserve.
So I guess when they issue me a loan, though, like I go get a commercial loan, then they're selling that, they're packaging it into bonds on the back end. Is that what you were saying? So
some loans are sold that way, but not all.
Yeah. And commercial loans even.
That would be agency debt, right? Fannie and Freddie type. So that's why when you go to close one of these apartment deals that you're going with agency debt, like they tell you when the closing date's going to be, not you tell them when the closing date's going to be, because they're literally, you're signing and they're going out. It only takes a day or two and they go out and they sell your loan on Wall Street, I guess. And then they fund the loan. And
so, yeah, you're saying the bonds, though, are the package of mortgage-backed securities, basically.
Yeah. Mortgage-backed securities are a form of bond.
Of a form of bond.
Yes. Yeah.
But you're not creating that same bond with all this commercial debt also?
No. Yeah. So think of it this way. The commercial debt is created at the individual transaction level, and then it's packaged together to create the bond. Yeah.
Okay. And then they're buying it, so then you have more money.
CMBS market. So you have the mortgage-backed security and the commercial mortgage-backed security markets. And I don't know a lot about these secondary markets, but that's what we were sort of alluding to with the Fed taking these things off of their balance sheet and putting them on their balance sheet. When they step in and they just say, we don't care if there's investors or not, we're going to buy them all. It changes the value of that bond. And when they decide we're not going to come in and artificially inflate that market, we're going to pull our chips off of the table. Now the free market has to decide what that mortgage-backed security is worth.
So you're saying that's the quantitative easing, and that's how, like, the dollar volume they are going to buy or not buy and hold of these.
So they're in QT now. They call it QT, quantitative tightening.
So they're not.
So it's not that they're not buying them. Well, they're not buying them, but they're also letting their current ones roll off their balance sheet.
Yeah. So they're essentially right now a net seller of mortgage-backed securities, meaning they're no longer buying any more mortgage-backed securities, but some are maturing and gaining paid off. So their balance sheet in regards to mortgage-backed security is shrinking.
And so now, because an investor has to buy it, they are only willing to buy it at a higher rate than the Fed is.
So that's why spreads went from 1.5% to 3%.
Because you're going to do your metrics on your returns different than the Fed is on money they're printing for an IOU, right? It's a different game.
And that's where the mortgage spreads. So when we talk about the residential rates, those mortgage spreads have no incentive to decline. with a strong jobs market and a Fed they don't want to be in the mortgage market
because of the risk of inflation going up, or because of the risk of the bond going up, the bond yield going up.
Because the risk, their inflation adjusted risk is still a tough thing to calculate.
Because one of the reasons why we're real estate investors is we borrow money at the value of today's dollar. And then we wait a long time and we pay it back later. And so you borrow $1 million today, and when you pay that $1 million back in 10 or 20 or 30 years, it's not $1 million anymore.
Yeah.
And so the bank has to look at that in reverse and go, we need to make a certain return on this. And that's why they want to give you shorter term money.
Yep.
They'd rather do a 3-year or 5-year loan, because the crystal ball, they know they can kind of gauge inflationary risk over that next 3 to 5 years. Once you start going out further and further, that's harder, which is why you end up, when you're in a residential loan, you have 30 years. So when you're trying to bake in 30-year predictions on inflation, what's going to happen? That money you're getting paid back in 30 years is inflation adjusted, is not anywhere close to what you lent out.
That's why commercial lengths are 10 years and residential are 30 years, because of the level of government involvement in the residential side versus the commercial side.
So the government is the only one buying those residential loans then, really, right? Because who else is buying those?
No. So insurance,
they still
pensions. Yeah. So they're the only ones buying them. And that's the problem. That's not the problem. That's why spreads are the way they are, which is what makes mortgage rates they are. And so that's the problem, is like when the Fed changed actions in March of 2022, they increased their activity, increased the yield on the 10-year, and then they're pulling away from buying, increased the spread. And so it wasn't just mortgage rates going up by the 10-year, it was mortgage rates going up for the 10-year and the spread. So it was a double dip. And that's why real estate's in a recession and the rest of the economy's not, is because they got double dipped. The rest of the economy got hit once just by the Fed's activity. Real estate got hit by the Fed's activity and the mortgage spread activity, the secondary market activity.
So if you had a crystal ball, which it sounds like you do, because you tell the Fed to follow your Facebook page.
No, the Fed, yeah. So they need to start creating a special new construction bond mortgage-backed security facility to keep us from being in a big problem 10 years from now.
With no inventory.
Because we're just going down that road,
which
is another podcast
seems to perpetuate itself. Yes. That's kind of
we're never going to fix it if they don't actually figure this shit out.
Yeah, they're not going to.
No.
So we're never going to fix it. So that's why we keep buying buildings.
Well, so yeah, my question is like, having all this information, what do you do with it? How did it affect your investing?
Yeah, well, that's so I ramped up buying significantly from September 22 to December 2022. And that whole buying opportunity is, hey, we're just buying rentals. And then in early 2023, fuck that. We're selling all those rentals. We're taking our tax hit because we saw another buying window coming again the same fall. So it was sell everything in the spring of 2023 so that you can buy stuff again in the fall of 2023.
Were you actually selling your 2022 product that you bought?
Took capital gains.
That was all value add stuff.
Yeah, all value. So there's significant capital gains, and it's just selling that asset and paying the taxes is a lot more. This the velocity behind the money. So there's the amount of money, there's the speed of money, and I've had the pleasure of talking to so many people who have bought real estate over decades of period of time. The number one regret, not trading enough. Like that one, and there's two avatars of investors in the Portland area that I think of. There's the one guy, Joe, that everyone knows, that owns all the apartments, that has the biggest nonprofit fund and all that stuff. And then I know his friends. And the friends are like, never increase rent, slumlord, never make improvements, yada yada. Joe's like, trade everything. He's a slumlord. He has his slumlord properties. He has his new construction properties. He has his commercials, warehouse, like everything. It's every asset class. And some of those, he has those strategies of moving money. Some of them he's a slumlord based on just trying to keep rents low. And so what I've learned and what I appreciate now, and actually I went to a conference of a business coach, a mindset conference. And one thing I took away from that was I was not aggressive enough with my portfolio because I missed out on the speed of money, and I don't want to make that mistake again. And so when you factor in your tax hit versus the gains you can take and now put those gains back in and speed that up, there's just a better return there.
Can't you, I mean, doesn't the tax hit almost like negate it? If you were to just cash out refi at that point, aren't you basically going to have?
And some of them we did. The problem is if you cash out refi when interest rates are 8% on a DSCR,
Yeah, you don't want it.
You got 200, 300 grand of equity in it.
If you started with a rental, though, you could have done some 1031 if you didn't want to take the tax hit.
Yeah, you can do an extenuate. If you didn't hold it for long enough, you can say the plan. And I've done this before in a 1031, or I've 1031 6 months after acquisition because
You held it in 2 tax
the
years.
the intent was to buy it for this purpose,
yeah.
and code changed that killed the metrics on that purpose. So it justified.
But you had a depreciation schedule going. You had a rent roll. You had the things that made it look like an investment, or no?
No. I just had all of the due diligence. I had the drawings. I paid, to develop it this way. I permit application, and then they came back and said, "Oh, we have this new code." So when I was buying the property, this code didn't exist. When I went in for the permits, this code exists.
Okay.
So my 1031 attorney was like, "Well, that'll qualify." But we got way off topic.
We're junkies. What do you
Yeah. Well,
expect?
so the speed of money, right? And so the plan is, and that's the whole thing, is market conditions never change this fast. So why I love real estate is it's really, really slow. But we're in an area where market conditions are changing faster than they ever have. The life cycle of a real estate cycle is 7 to 8 years is what they teach you. We went through that in 12 months. So we're seeing and I made this post recently is like, hey, 20 years from now, economists are going to be studying the phenomenon of COVID and mortgage rates in the real estate market.
Absolutely.
But you could just listen to Zillow and they'll tell you our values are flat. Right? Because they are. I mean, you can look at, values have kind of been flat over the past 2 years or so. Yeah, but it's gone like this, right? And so you use this, you get ahead of it. So when the market's going like this, sell. When it's going like this, you buy, right? And then you change your strategy if it makes sense to change your strategy.
Do you have any estimation of when you think this COVID, did it throw us into this sort of quagmire that we're just going to keep spinning like this out of control for a long period of time? Or do you feel like the post-pandemic sort of hangover is going to come to an end at some point and we will actually enter into a more normal period again? Or is that over?
And I don't think you can blame it on COVID, but I think COVID was the point of no return since 2008. Right. So essentially I look at it as modern monetary policy took effect in 2008. And then COVID just took us so far down the road that we've used tools we never thought of using. And we saw how it worked out and we're addicted to it. And so it's not COVID and it's not monetary policy. It's also political will. So we're at a point where we have no political will. Left side's fighting with the right side harder than they've ever fought. We're kind of on the brink of the Civil War. We're never going to get an agreement that as a government, we're going to hunker down.
Yeah.
We're going to spend
Do
less.
what it takes.
We're going to tax more.
Yeah.
It's just never going to happen. Yeah. And so that means we're in this modern monetary policy world where it's purely based on debt and monetizing debt. And it's the metrics around how much debt do you create? How much does that debt cost? How much income do you create? How much of that income is going to pay off your debt expenses? And now it's this juggling of 6 month, 1 year, 2 year, 10 year, 30 year debt at the government level to try and get a blended rate. And this is the example I love early on. So we'll take 2021. So inflation was 8% we'll just say it averaged out at 8%. Government borrowing debt was 2%.
Mm-hmm.
So, and they have 30 trillion in debt.
Mm-hmm.
So essentially they're saving 6% on 30 trillion. The government saved $1.8 trillion in the year of 2021 on their debt payments from financial repression. And so that's where economics changed for me when I understood financial repression. So as borrowers, we want to borrow today and pay at a cheaper dollar. So our lenders we're paying it off, right? Well, the opposite. So we're paying it off with less dollars. So we're not paying as much for that asset. The opposite is the saver who puts their money in the bank.
Right.
And there's almost a dollar drawdown. The money we save on an inflation adjusted pay down is the exact loss the saver makes in their bank account. Mm-hmm. And so now you throw financial repression into that equation. Can't remember what we were talking about.
What is financial repression?
That's the phenomenon of explaining how savers pay down our debt.
Oh, I see. So the kindergarten question of where does the money go? We're always wondering well, there was money and now there's no money. Where did it go? And this is your answer. It's really a transfer of wealth. It's moving it from this side to this side. And so savers are losers.
Yep.
not maybe personally, but just in the investment world, they're losing because their dollars are depreciating in value faster than they're making interest payments on that money just sitting there stagnant. So you never want to let money sit. It's kind of one thing. You talk about speed of money and movement of money and those sorts of things. So then on the flip side of that, if you're borrowing money, you're incentivized because this is the way our system is rigged. It's built this way. It's built for the people to borrow money, and that's how you're gonna make your money is by sitting on those investments, and then the inflation, your asset values go up faster than than it would be if you left your money sitting somewhere. So I always have to boil it down to kindergarten for me because I'm not as smart as you are, but I always say that they can print money faster than we can print buildings. so forget about parking the money and just go get your name on building.
Well, and you touched on this. I made a post the other day, which is the whole wealth redistribute conversation. You don't have to, like, our banking system redistributes wealth for us. They take it from the middle class because the middle class put their money and save it in the bank, and then the bank gives it to the Fed, and the Fed gives it to the government. And so then the government gives it to rich people through tax breaks and poor people through subsidies. And so we literally redistribute wealth from the middle class and give it to the rich and the poor through our banking system.
Wow. We're gonna stop right there. This has been a great conversation about economics. Whoever knew economics was so exciting? Did you, Dane?
No,
you were supposed to lead this whole podcast. Where were you?
Mike led
Did
it.
you fall asleep?
I asked the right question, and then he just.
It was only one question.
I did lead the podcast.
What an interviewer you are.
Yeah.
Well, okay, awesome. Well, anybody else have anything before we wrap this up? What is this? Is this an episode, or is it just a
standalone one-off?
Segment. We'll post
4B.
This is Macro Mike's bonus episode.
Macro Mike talking about economics. It's been a pleasure. Thanks for joining us here on Deal Junkies. See you next time.